Joining me in the center ring is senior fellow with the Brookings Institute and former vice chair of the Federal Reserve, Donald Kohn. Welcome, Mr. Kohn.
Good to be with you, John.
So let's start right from the beginning. What is the Fed?
The Fed is the nation's central bank. It's the bank that was put in place in order to help the U.S. economy grow and prosper, put in place in order to prevent financial crises and deal with them when they happened. You could think of it as a banker's bank. It's a bank that banks can come to borrow money when they absolutely need to. It's the central monetary policy authority in the United States, tasked by Congress with stable prices and maximum employment.
So the Fed itself, as we call it, how does it affect the American economy and Americans as a whole?
So a couple ways it affects the American economy and Americans as a whole. The primary way is through monetary policy. What's monetary policy? That's mostly raising and lowering interest rates in order to keep the economy on a steady course, in order to keep unemployment low and inflation low, price stability. So, for example, as last week, the Federal Reserve was a little bit concerned about the labor markets weakening. The unemployment rate had risen a little bit. People were having more trouble getting jobs. So they said, let's stimulate the economy. How did they go about doing that? They went by lowering interest rates. They lowered the interest rate they target for money markets, for very short-term markets, called the federal funds rate. They lowered it by 1/4 point. Not a big deal, but it is lower. What they do then radiates through the financial markets. So the price that you and I the rate that you and I might pay when we borrow to buy a car or to buy a house, a mortgage, is 4 years, might be 30 years for a mortgage. The rate a business might pay when it thinks about putting up a new factory and borrowing to put up a new factory, maybe a 4 or 5 year rate. So the Fed doesn't control those rates directly, but when it raises and lowers that short-term rate, it tends to radiate through the economy. So the hope was last week, we've lowered rates by a little bit. Households and businesses will be encouraged to spend because the rates they will be borrowing at should also be a little lower over time. So that in turn, if people are encouraged to borrow and spend, that means businesses will have demand. They'll be hiring people, and this weakness in the labor market that Jay Powell talked about should be very, very limited if businesses and households are doing more spending.
So you're talking about weakness in the labor market and your lower rates generally to stimulate the economy. The big bugaboo seems to be that inflation is ticking up a little bit. And so that's something that the Fed has to balance out and make game time decisions, taking into account everything?
Absolutely. That's a very good point, John. So we're actually in a fairly unusual situation in which inflation, they want low inflation. They want prices to be stable. Congress had told them that's your job, one of your jobs, to keep prices stable. They told them the other job was to keep employment high, to keep people working, making sure that people who wanted jobs could find jobs. Usually those two things go together. If people are having trouble finding jobs, inflation is generally low. If the jobs are abundant, inflation can tend to tick up. We are in an unusual situation right now in which those two goals are in tension. Inflation is ticking up while job finding is going down. And what the Federal Reserve said on last week when it lowered rates, and Jay Powell explained in his press conference, is we're a little more worried about the job situation than we were just a couple months ago. The inflation situation is unusual, and it's somewhat worrisome, but hasn't gotten worse. And part of the inflation picture now is the tariffs that the Trump administration has put on. So tariffs are a tax on U.S. consumers. U.S. businesses that buy imports from other countries, buy goods from other countries, and then resell them to U.S. households and businesses. So that tax has gone up. The Trump administration has increased that tax. Businesses, of course, to some extent absorb that increased cost, but they also try to pass it on to consumers. And although the pass through to consumers has been a little less than economists expected at the beginning of this tariff round, it still has happened. So we find prices of goods that are subject to tariffs are going up, and a bit more slowly, but they're going up. So some of the inflation is temporary because it's just passing through these tariffs and it won't be continued. But it's not clear that all of it is. So yes, you're right. The Fed finds itself in a very tricky position right now.
Now let's switch gears a little bit, and I want to talk about the influence of government and government leaders attempt to have on the Fed. And President Trump is nothing new to this. Many other presidents have attempted to do the same thing. So what keeps the Fed from being overly influenced by leaders or members of Congress?
Well, you're certainly correct that President Trump is not the first president who wants interest rates to be lower or who objects to interest rates going higher. As I think back through the Fed history just after World War II, Harry Truman didn't want rates to go up. Lyndon Johnson very famously tried to fight the Vietnam War and didn't want the Fed fighting the resulting inflation by raising rates, and he berated the chairman of the Fed at the time. Richard Nixon put a lot of pressure on Arthur Burns not to raise rates, particularly before the 1972 election. Ronald Reagan ordered Paul Volcker not to raise rates before the '84 election. So this is not George H.W. Bush and, of course, Donald Trump. So it's very common for presidents to want rates to be lower. Why? Because lower rates, as I just said, lower rates tend to stimulate the economy. They tend to stimulate spending, stimulate employment, and of course that's good for re-election. And often the inflation result of stimulating the economy too much, of pushing demand against available supply is delayed beyond the next election. So presidents often want interest rates to come down, especially when they're looking at elections, or in the case of Donald Trump, a midterm election that he wants his party to be successful in.
So, Mr. Kohn, let me interrupt you just briefly. We have about a minute left, and I just want to finish with this note, and that is, if you could just summarize for us why it's so important for the Fed to remain independent.
So it's important for the Fed to take that longer term perspective, to see that if you push the economy really hard in one direction, it's eventually, if you stimulate the economy, eventually you're going to have inflation and everyone will suffer from that inflation. So you need someone sitting there with an arm's length relationship to this political process in order to take that longer perspective for the benefit of the American people, to keep inflation down over time, to have that good perspective.
Thank you very much for your time, Mr. Kohn, and your time on the Fed as well.